Hi class, welcome to Chapter 2 of Investments. We're going to get started on the slides. Again, if you have any questions, feel free to email me or reach out to me on the message boards. For the quizzes, by now you've taken the first one. Just make sure to focus on the questions in the back of the chapters, as well as the keywords, because they're all fair game for any quiz I give you guys. Okay. So Chapter 2, Securities Markets. Okay? Learning objectives for this chapter include the functions of the financial markets. What do they do? Okay? The role of investment bankers. Okay? What do they do? Okay? Organized exchanges versus over-the-counter markets. The future outlook for capital markets. Legislation affecting capital markets. The market environment, market functions, organization of the primary markets, organization of secondary markets, and the organization of the New York Stock Exchange. Okay, so securities markets. We have the Nasdaq stock market. We have ECN, or electronic communication networks. Other organized exchanges, over-the-counter markets, institutional trading, and regulation of security markets. We're going to go into detail on all these topics. Okay, the market environment. Always continual changes going on in the market environment. Why? Changes in the composition of the stocks that comprise the market, change of laws, tax regulations, anything that Congress does that can have an effect on the markets, deregulation or additional regulation, as we're seeing in the news now, global consolidation and competition. We'll see this in, I think the New York Stock Exchange tried to buy another exchange market this past year. I think it was the Euronext. Online brokerages and electronic communication networks, real-time quotes, and the Sarbanes-Oxley Act are have a huge impact on the market. It wasn't all that long ago, 15 years ago, where it was a lot more difficult to get real-time information on the markets. Now anybody with $1,000 in an E-Trade account can have access to real-time quotes from the market. The more information either an individual investor or an institutional investor has, the better they can act on the information they're given. Sarbanes-Oxley Act is a corporate governance regulation that is large and extremely complex, but it basically has the CEO and CFO of an organization sign off on their financial statements. This was enacted after, I believe, the fall of Enron, and the reason for that was so that the higher-ups in these organizations were not able to kind of claim ignorance on things that were going on inside their company. They had to actually sign off on the financial statements. Okay, market functions, okay? What is the market? You'll see the book mention this, and you'll hear me mention it, like, how's the market doing? Well, what is the market? Okay? The market is just a simple way of exchanging assets. Think about it like a regular market, like a store market or a supermarket, right? What are you doing in there? You have assets that you're exchanging for other assets. Now, what I mean by other assets for other assets, cash is not the only asset. Stocks are considered an asset. Bonds are considered an asset. Real estate is considered an asset. Okay? Efficiency and liquidity are key characteristics of a good market, right? Why is liquidity a characteristic of a good market? Well, because that means the goods can be exchanged, quickly, easily. And in this case, by goods, I mean the stocks. When we place an order to buy or sell a stock, in most cases, it happens fairly quickly in stocks that are traded in the U.S. Okay? Efficient. It relates to liquidity. You want to be able to get the fair price. You want the trades to happen quickly. Okay? Competition and allocation of capital. Okay? Everybody's competing for our capital, right? And by capital, I mean dollars. Okay? That means the bond investors are competing with the stock investors, who are competing with the real estate investors, who are competing with private equity money, who are competing with hedge fund money. There's only a fixed amount of assets that we have, and all these different parts of the financial market are competing for those dollars. We can take, let's say hypothetically you have $100,000 in the bank account. I wish I did, right? And what are you going to do with that money? You only have a limited amount of options. Are you going to put it in bonds, stocks? You're going to open up your own restaurant? You're going to go to a private equity fund? You have many different options to allocate your resources. This competition among these different functions helps create the price market. It's very supply and demand economics. Okay. Secondary and primary markets, very important topics that I'm going to discuss. Primary markets are where IPOs are sold. So think about it like this: when Facebook is the latest and greatest IPO. When Facebook has an IPO, Facebook, usually through an investment banker who underwrites the securities, will sell the stock to the public. Now, when they sell the stock to the public, that's it. They've kind of got their money. So, for example, Facebook might have sold, let's say, 10% of their company on the stock market. So the first day of their IPO, they're putting it out in the primary market. Okay? How that usually happens is they'll have an investment banker who will price their securities. They'll say, well, if we think your company's worth $100 billion, okay? So we're going to sell 10% of your company for $10 billion. And we're going to divide that by X number of shares. One thing that's a hard concept for people to get at first is that the dollar value of the share is kind of arbitrary. It's really what percentage of the company does each share own, if that makes any sense. And please feel free to shoot me a question via email or message board, and I can go into detail on that further. So when Facebook sold their stock for $38 a share, and then it subsequently tanked over the next 2 weeks, that technically really wasn't all that bad for Facebook. It was bad for the investors in Facebook on the secondary market, which I'm going to touch base on in a second. So why did it matter for Facebook? Because in the primary market, the day of the IPO, they sold all the stock they wanted, that full 10%, for $38 a share. Okay. Subsequently, the price drops on the secondary market. The secondary market, which is all these markets that we're going to touch on pretty briefly, are going to, what we consider when we're trading stocks, like when we buy a stock off the New York Stock Exchange or the Nasdaq. And in most cases, as a personal investor, you won't really know the difference whether you're buying a stock off the Nasdaq or New York Stock Exchange or really any exchange for that matter when you're going through a brokerage account. Okay, so Facebook sells a stock, $38 a share. Mark Zuckerberg is a billionaire, and subsequently in the secondary market, the stock starts to fall. Now that will have an implication on future stock offerings. Facebook does, because now that we know what it's worth, how do we know what it's worth? Well, we know what the company's worth by what it's trading for on the secondary market. Okay, so if Facebook tomorrow said, you know what, we're going to sell another 10% of our company on the stock market, they could only get what it's trading for today. They couldn't get, and probably less, because once you introduce, more supply, in theory, all else being equal, more extra supply will lower demand, causing depression in the price. So that's a basic idea how the markets function. I'm going to get into details too on how investment bankers fit into all this. Okay. And here it is in the next slide. Organization of primary markets. They do the underwriting function. Investment bankers generally handle the underwriting of the security. They're middlemen involved in the distribution of securities from issuing corporation to investors. So they're the middleman between the investors and the company itself. So by underwriting the security, let's say Facebook is selling at, like I said, the day of the IPO, they're selling at $38 a share. Okay. In general, investment bankers will take about a 2% fee. So let's break out my calculator here. Okay, 0.98 multiplied by 38 37.24. Okay, so 2% of 38 is about 75 cents. So, in theory, the investment bankers on the Facebook stock made about 75 cents for every share sold of that Facebook stock. How do they make that money? Well, they have an incentive to price the security correctly and price the company, value the company correctly. So they'll come in and say, well, we think your company's worth this amount of dollars. We're going to sell this many shares, and this many shares is going to be based on 10% of your company, and 10% of your company we think is worth $10 billion. Okay? So, what happens next is that most investment banking deals, the investment bank will assume the risk and say, all right, we're going to sell your securities. We're going to guarantee we're going to sell 10% of your securities, sell them all out, but we're going to sell them for 38. So you're going to give them to us for $37.25. Okay? That gives the investment bankers some wiggle room in terms of if the stock price drops. Now, or if the IPO shoots up, guess who's making a lot of money? The investment bank, because they only promised Facebook $37.25. A good IPO is when the price stays around the IPO price, at least from a corporate point of view, from one such as Facebook. Because let's say the IPO of Facebook shot up to $50 on the day of the IPO. That means the investment bankers actually did a poor job in pricing the IPO. They didn't get Facebook the value that it could have gotten if it was priced correctly. Now the same thing could happen on the flip side if they have the IPO, and the day of the IPO, the stock goes from 38 to 35. The investment bank is going to get crushed because they already guaranteed they were going to sell the securities at 38. And if they have to sell them at 35, well, guess what? They're going to take a loss. So they generally try to not have that happen. There's also the option of best effort. If they sign an investment banker up on a best efforts basis, there's no guarantee that they're going to sell the security, right? And then sold directly. Google did something like this when they had their IPO. They didn't use an investment bank. They used a Dutch-style auction, which I'm not going to get into in this chapter or this class, but they basically sold direct to the public their stock, okay? And obviously you say there's a cost savings in doing that because you're cutting out the middleman. A couple other things. Distribution. They have a syndicate. A syndicate is a group of investment banks sharing the risk and burden of distribution. In the Facebook deal, there was more than one investment bank involved in the deal. There was a syndicate. Okay. Prospectus, something that you should become very familiar with. It's an advertisement for a stock or bond, but we wouldn't consider it an advertisement in the traditional sense, because it's not like an ad you'd see on TV or in a magazine or on the web. It's a document that describes the details of the stock, the bond, the mutual fund, the risks, the rewards, who's involved in the management of the money, the fees involved. So it's a very extensive piece of marketing material. Okay. Investment banking competition. The process of bringing private companies to the public market for the first time is considered an IPO. Obviously, that's a no-brainer. You should know that for a quiz. It is the first issue of stocks or bonds. So Facebook will never have another IPO unless they get taken back private and then a couple of years later, go and have another IPO. That doesn't happen very often. Dunkin' Donuts, I believe, is the only company that comes to mind that happened to. They were a public company, then they became private, and then over the last year or two, Dunkin' Donuts again became a publicly traded company. What are the advantages to becoming a publicly traded company? It's basically you're getting additional investors. Think of if you have any kind of business, right? If you take on a 10% partner in your business, right? They want to buy 10% of your company. They have an ownership of 10%. But with an ownership of 10%, they can participate in the risks and rewards of the business, but at a 10% stake, they don't know, they don't have the ability to really influence the company, okay? Another reason why we would go public or have an IPO is maybe we want to know what the value of the, value of the company is. Well, you might say, well, how would we not know what the value of the company is? Well, think about it this way. Let's say I had a townhouse, and the townhouse had 6 condos in it, okay? I had no idea what the building was worth, but I wanted to get a better idea of how much the whole building was worth. And for this example, we'll assume all the condos are the exact same size. If I sold one of those condos for $100,000, I could make an assumption now, based on market prices today, that if one of the 6 condos sold for $100,000, that the building must be worth $600,000, right? That makes sense. So you're selling a portion of the company, a small portion, to get a better idea of the value of the whole company. Okay? So here's just a list of stock exchanges and regional markets. New York Stock Exchange, American Stock Exchange, Nasdaq. We also have regional exchanges. The only one that really matters now is the Chicago Exchange. The rest of the ones, Boston, Philly, and Cincinnati, are not really too relevant anymore. Why? Because of electronic trading has really taken over. Organization of the secondary market continued. So consolidated tape shows the price of transactions on other exchanges and duly listed New York Stock Exchange stocks. So there are sometimes stocks that are listed on more than one exchange, right? What's the advantage to being on a certain exchange? Greater exposure, When your stock is on the New York Stock Exchange, for example, it's probably going to be a more liquid stock. It's going to be a larger company. Over-the-counter stocks, or as they're called, OTCs, are generally smaller firms that are less liquid and traded far more infrequently. New York Stock Exchange has the most restrictive listing requirements. What kind of listing requirements are they going to have? Based on the size of the company, based on the liquidity of the company, based on the amount of shares that are available. And then, what is the New York Stock Exchange and the Nasdaq are all businesses. So they charge a listing fee as well to be on their exchange. Okay. A little bit on the organization of the New York Stock Exchange. So they have floor brokers. They act as agents for clients and execute buy and sell orders on the floor of the exchange. I'll try to post a video on this week's topic on a little bit more detail about this. So we have house brokers. They execute orders for customers of the New York Stock Exchange, for firms such as Merrill Lynch and other firms' direct accounts. And then we have independent brokers. They're individuals or employees of a small boutique firm that execute orders for member or non-member firms and help house brokers with overflow. So they're handling the trades that are coming and going into the market, right? They're regulating all this stuff. So next we have specialists, okay? They account for about a quarter of the exchange memberships. You have to buy a membership to the American Stock Exchange to trade on their floor. It's almost like buying a special license. Each stock has a specialist assigned to it. Most specialists are responsible for more than one stock and handle special orders such as limit or bid offers. And their primary goal, and this is a great quiz question, what is a specialist goal or primary responsibility? Maintain a continuous, liquid, and orderly market for their stock. Okay? So they'll have an inventory of their stock as well. They won't just kind of, act as like, buy this, sell this. They'll have an inventory of the stock they're assigned to kind of help liquidity in that market for the stock. The American Stock Exchange became part of the NYSE Euronext group in 2008. That was a consolidation. More recently has differentiated itself by offering ETFs and SPDRs. ETFs and SPDRs are exchange-traded funds. They act a lot like mutual funds. You'll probably hear me talk about this more than once in the semester, except that they're mostly index funds, which means they're passively invested, which means that their performance is tied to a specific benchmark. Okay. The Nasdaq stock market. I won't, for a quiz, I'm not going to focus as much on, tell me the details and the differences between the Nasdaq and New York Stock Exchange market. I think there are much more relevant topics in the book and in the chapters for you guys to focus on that, what's our end goal here with this course, right? And continuing in your education, you want to get a job, right, in finance. And I don't think differentiating between the New York Stock Exchange and the Nasdaq stock market, that's more a trivia question than it is a practical, real world question, which I'm going to try to focus on. So, recognized as a national securities exchange by Securities and Exchange Commission, SEC, in 2006. It's the second largest exchange in the U.S. by dollar volume. The Nasdaq is also a traded company, right? So they're also traded on the Nasdaq, and their symbol is NDAQ. Okay. Electronic Communications Network, ECNs. You guys should know a little bit about this for a quiz. Electronic trading systems that are automatically match buy and sell orders at specified prices. So, this makes sense, right? All this stuff about buying and selling, we don't need people yelling back and forth on the trading floor, although it seems like a fun and interesting job. Computers can do a lot of this stuff for us, okay? They're also called alternative trading system. They act as a broker-dealer or as an exchange, and retail and institutional investors, market makers, and broker-dealers all use electronic communication networks. Advantage, they integrate the markets. They allow anonymity in trading. Why is anonymity in trading important? Well, anonymity in trading is really important because let's say you're a hedge fund or you're some type of black box quantitative investment manager, which means basically you have a secret recipe for how you pick stocks so well, right? If all of your trades are public and everyone knows what you're buying and selling, then somebody could, in theory, spend a little bit of time and kind of backlog your method and to kind of figure out your trading algorithms. So anonymity is important in trading. Electronic communication networks also offer lower cost of trading. So there might be, one company or investor or corporation or what have you might want to sell a stock, and the other one might want to buy that stock. So they can do that off the general exchange and do it through an electronic communication network. Institutions can trade among themselves and bypass brokers and trading fees, exactly what I'm talking about. They permit after-hours trading, they have longer trading hours, and they facilitate more competition and smaller spreads. As I said last week in Chapter 1, when we have smaller spreads, what does that mean? Good quiz question. Smaller spreads between bid and ask prices mean that the market in that asset is more liquid. I love using real estate as an example. For example, I'm putting my house on the market. When I put my house on the market at, hypothetically, I wouldn't do this, but at $100,000, do you think that people are going to offer me $100,000, or am I going to have one person walk in and offer me 80, and another person walk in maybe and hopefully offer me 105, and another person might offer me 95? There's going to be a wide margin between the bid and ask prices, all right? And that's because real estate is generally illiquid, okay? Other organized exchanges, I won't go over this here in the lecture, but please do the reading on this. I might ask you a trivia question on one of these to make sure you do the reading, like what is ICE, okay? Futures markets, okay? Trade the right to buy or sell a certain amount of commodity or financial instrument at a set price delivered at a future point in time. This idea of futures can be a little complex to understand at first, right? Futures are basically used as, a lot of times anyway, as a hedging mechanism, okay? So let's say, and this is very common practice, let's say I'm in charge of Southwest Airlines, okay? And I believe, based on our analysis, that gas prices are going to rise dramatically, okay? And gas prices have a huge impact on the airline industry because that's what it uses to run. It uses fuel. So what would I do as a business manager for Southwest, and they did do this, is that I would try to be as accurate as I can in predicting oil prices. And if I can correctly predict oil prices, I can say, well, if I believe that oil prices are going to rise dramatically over the next 6 months or a year, I can buy oil futures. So I'm basically agreeing to buy oil 6 months from now at a price we determined today. So if I believe the analyst expectations are all wrong and they're pricing lower oil much lower than I believe it's going to be, I can say, oh, this is perfect. I am going to buy oil futures today. So I'm locking in my price 6 months from now on futures today. Okay? So that's basically how it works. Contracts are normally reversed or closed out prior to expiration. In most cases, when you're buying futures, it's you generally don't take delivery of the asset. If I bought orange juice futures, generally I could take delivery of the orange juice, right? But more likely than not, I will close out my position by entering in a reverse contract. Okay, and this is the reason why the Chicago Exchange is so relevant, because they handle the commodity futures exchanges. Okay, over-the-counter bulletin board market, small companies, no listing requirement, and companies still must file reports with the SEC. So minimal paperwork, you can get over-the-counter stock, and that's it. The problem is exposure. You trade OTC, it's harder to gather assets, it's harder to get your stock noticed. Okay, pink sheets are companies choosing not to file with the SEC, and little public information is available. So you hear about penny stocks occasionally, and you can probably see spam advertisements on the web about you can make thousands of dollars on penny stocks. Well, you could also lose a lot of money as well. That's because there isn't as much information available on the stock. Now, this actually ties back to something I forgot to mention when we talked about efficient markets. Okay, in an efficient market, news about the company flows really quickly into the value of the stock. Right? So if we're talking about Dell computers and we find out today in the news that Dell Computers head of marketing, who's been instrumental in their marketing campaigns, is leaving the company to go work for a competitor, right? That news would hit the media and immediately have a negative impact on the stock, all else being equal. Why? Because it's a stock that a lot of people analyze, it's a stock that is traded very frequently. So any news gets priced into that stock very quickly. Now, news can get priced in throughout the day. Like things can change. Then, he announces his retirement, and then, other stuff can happen that mitigates the impact of him retiring. Maybe he wasn't as important as the initial news said he was, and the stock can kind of bounce back from that. But all that happens in real time. The stock will, shake and move in that sense. Okay? Now, when you have little public information about a stock, guess what's going to happen? That stock's not going to be as efficient, because if it's a stock no one looks at, no one cares about, maybe no one trades in every day, news could come out about that company, and it's not going to be as widely dispersed, so you're not going to know about it as quickly, and the market's not going to know about it as quickly. So it's going to have a higher degree of inefficiency. Okay. OTC stocks, basically this slide says OTC markets exist for everything. Stocks, bonds, mutual funds, government securities, local bonds, commercial paper, etc. Okay. Difference between the bid-ask price, which is also the dealer profit earned by making a market. OTC stocks will have a higher spread. This is because why? They're not as liquid and they're not as efficient. Okay? That's the key concept I want you guys to get here. Government securities can be traded over the counter. It's the largest dollar volume on the OTC, billions of dollars traded each week. They can be T-bills, T-bonds, any one of the Fannie Mae, Sallie Mae, Ginnie Mae securities can all be traded OTC. Institutional trading, when you work for a big asset manager like a State Street or a Putnam or where I currently work, Acadian, you're going to be involved in institutional trading. Why? Because it helps keep your trades more secret, right? And I already explained why that's important, okay? Dark pools are electronic networks used by institutional investors to use algorithmic trading, okay? That's basically quant trading. You have a computer set up that says, when these factors change, we're going to buy the stock. And when these factors change, we're going to sell the stock. And the reason why I say these factors instead of giving you specific factors, it's different for everybody. You know, these factors that will trigger a sell or a buy are going to be different for everybody. Okay. Regulation of security markets. Okay. Organized exchanges regulated by the Securities and Exchange Commission and is self-regulated. The OTC market is regulated by the National Association of Dealers, or the NASD. For a quiz this week, I want you to be able to tell me a little bit about the Securities Act of 1933, 1934, and 1975. What were the most significant impacts of those security laws? Again, this is mostly trivia. But I want you guys to have a general understanding of why these laws were enacted. Okay. Securities Act of 1933, the Truth in Securities Act, pertains to new issues of securities. What are new issues of securities? IPOs. Okay. Registration with the SEC is required for new issues of securities. 20-day filing requirement in advance. So you have to give the government, basically, they're asking for 20 days to review your paperwork. This was one of the big changes with the Securities Act of 1933. A prospectus required for a new issue. Basically, you couldn't just wing it and say, all right, this is the information on the stock. You had a legal marketing document that gave all the details that the SEC requires on this new issue of the security. Okay? Officers and others can be sued for losses resulting from fraudulent or incomplete information in the prospectus. So it puts an onus on the people in charge of distributing these stocks. Okay. 1934. 1934 created the Securities and Exchange Commission, the SEC. It established rules for insider trading, the Board of Governors for the Fed. Manipulation of securities became prohibited, illegal, insider trading. SEC given control of proxy procedures. We'll get into that later. Required periodical reports from companies traded on exchanges. So, if you're a publicly traded company, you need to give the public information such as balance sheet, cash flow statement, income statement. It required all exchanges to register with the SEC. So, a year later, they had this law and regulation to further tighten the loop on securities exchanges. You'll notice the timing of this coincided with the Great Depression. Because after the Great Depression, there were so many fraudulent investors. You know, we hear about the word Ponzi scheme associated with Bernie Madoff, but the Ponzi scheme was actually way back in the 1930s. One of the reasons these laws were created. Okay, that type of activity. Securities Exchange Act of 1975 assumed extensive use of computers and electronic communication devices, prohibited fixed commission on public transactions, and prohibited banks, insurance companies, and other financial institutions from buying stock exchange memberships to save commission costs for their own institutional transactions. Okay, so they couldn't buy, these certain companies couldn't buy exchange memberships. Okay, that has to be left to a separate company. It regulated that. They wanted them to be separate organizations. Excuse me. We'll skip this one. Insider trading. Definition of an insider includes anyone with special non-public information. Punitive measures discourage illegal use of insider trading. Insiders may make proper long-term investments in corporations. Now, here's where, the infamous insider trading case of the last decade was probably Martha Stewart. There's also this another guy, I think is by the last name of Gupta, who's fairly famous in the financial world right now for insider trading. But Martha Stewart, what happened with her was basically somebody who worked for the company or was associated with the company in question said, something negative is going to happen here. I would dump the stock. Now, she probably wasn't familiar with insider trading laws, or was just ignorant of them, or chose not to obey them. From a personal perspective, and this is why insider trading can be so tricky, is that if you knew somebody who worked for the company that you were invested in, and they said, this thing's going to tank, I think most people would be very tempted to sell the security. Why would you hold on to it? However, that's the whole point of insider trading. You don't want people having inside information who can profit on that while the rest of the public suffers. So that's the reasoning behind those laws. Now there's something that I don't think is directly discussed in this book, but it's discussed in the CFA program. It's called the mosaic theory. So if you have, if you see two CEOs having lunch together and you think they might be a merger target, and you see them having lunch and talking in an elevator, and then make an analysis of both the companies and then determine that you think one of them might buy the other because you saw them eating lunch and you saw them talking about business and then did an analysis based on that. That's actually not insider trading. You're using kind of the mosaic theory where you have a little bit of information about inside stuff, but you also combine it with a bunch of other outside sources of information, and that makes it okay. Program trading. Computer-based trigger points are established in which large volumes of trades are initiated by institutional investors. It may increase market volatility. Circuit breakers shut down the market briefly when there are specified dramatic drops in stock prices. And stock prices can occasionally swing wildly. This could be because of a trading error. One time, I was the beneficiary of a small trading error. It was a penny stock, and I put in a sell order at market on an illiquid stock, and it was trading at 2 cents. And somebody put in a buy order. Instead of putting 2 cents, they put 20 cents. And because the stock was illiquid, I was able to make that transaction and make a nice little profit on a small investment. Because of what? Because of a trading error. And it caused the price of that stock to increase dramatically for a short time. A little bit more exploring on the web. Here's just a list of the websites on each of the exchanges we talked about, as well as some other news sites. This is the last slide for the chapter. I know last week I said I'm going to try to keep the lectures to 20 minutes, and I noticed my chapter 1 lecture was 50 minutes. So bear with me, I'm going to try to tighten it up as well as give you the most information as possible. And I look forward to continuing educating you. Please, like I said, email me if you have any questions, comments, suggestions, and we'll see you next week.